call goes and the Nifty opens at 19,380, a cut of nearly 50 points. 19,257 was the intraday low, and from that, we've managed to rebound about 50 to 60 points.
For the markets, it is down 50 points. The 19,379 is the mark.
We're looking a bit washed out, right? I mean, early on, we were down 150 odd points, but I think we're now almost in the green. Are we there?
Well, the end will be negative once again. The bulls couldn't hold on to that little bit of green 20-30 point rally that we had on the Nifty.
Hello and welcome to Markets Today, the show where we track about 6 hours of the day's trading action in just 5 headlines. I'm Ekta Batra. Here are the top stories for this evening. The Sensex and the Nifty recover in late trade to end in the green. IT stocks lend support, but bank stocks see profit booking. All 10 Adani Group stocks decline in trade after Deloitte resigns as the statutory auditor of Adani Ports. The group's market capitalization declines by 25 crores rupees. Divi's Labs reports a weak first quarter, missing expectations on all parameters. Net profit declines nearly 50%, while revenue dipped 21% on a yearly basis. Weakness in the fashion business and softer margins hurts Nykaa, while ABB takes a beating despite healthy numbers on profit booking. Over pricey valuations, Muthoot Finance loses ground as growth is driven more by gold prices. Morgan Stanley downgrades it to underweight. SEBI seeks 15 more days from the Supreme Court to submit its report on the Adani-Hindenburg matter. Market regulator says the probe is complete in 17 out of 24 investigations, and it is awaiting information from foreign regulators and agencies. All right, well, let's also tell you what we have lined up for you this evening. It's a packed show as always. In Market Opinion, we have Devina Mehra, founder and managing director of First Global, Sridhi Bhattacharya, who is the Chief Investment Officer at Edelweiss AMC. Well, straight to all the market action then. It is the eve of India's 77th Independence Day. The Sensex and the Nifty have gained a whopping 10% each since last independence. However, a volatile day on Monday saw the market close at a flat line but was off the day's low. IT stocks and Reliance lent support, helping the Nifty end mildly in the green. Meanwhile, banks continue to languish, with the Nifty Bank ending the day close to 0.25% in the red. Mid-caps also underperformed the blue chips. Prashant Nair is here with a wrap.
Well, it was a lower start, but by close, things had completely turned around. The Nifty ending actually higher. In the morning, at one point, the Nifty was down about 150 points. Same is the case with the Nifty Bank, which saw a very sharp recovery from the day's low. Mid-caps and small caps, the small cap index especially had taken a hard knock, was down almost 2%, and it ended marginally in the red. So, you know, the motto of the market has been not to stay down, and I think today was no exception, with things recovering quite a bit. So, a pretty good day all told. Let's just quickly take a look at broader markets, because that's where the action has been. In large caps, there were a few names like Divi's, Reliance was a big contributor for the recovery that we saw. But beyond that, it was, broader markets where there was all the action. And I'll start with losers here, because there were more losers as compared to gainers, although the gap did reduce by close. Lots of result reactions. Nykaa, for one, took a sharp knock. Muthoot Finance was a big loser. There was JSPL, which was down sharply. City Union, Timken. There was Avalon, 20% cut in the last 2 sessions now. Phenolics Cables, Kirloskar Brothers, NRB Bearings, there was Birla Corp, and so on and so forth. Many of these stocks have run up quite a bit, and occasionally, as we've observed over the last 4 months or so since the small cap rally began, you see these pullbacks. What did well? Shipbuilders. We had the management of Garden Reach with us earlier on in the morning, and they gave some pretty large numbers in terms of the opportunity size for the shipbuilders out there. So not just Garden Reach, but the other two, Mazgaon and Cochin Shipyard, also doing very well. Apart from that, gains coming through in names like NMDC, Bombay Dyeing, DB Realty, Genus Power for the longest time has been stuck at about 190. Clean breakout today. Amber reacting pretty well. RateGain, early last week numbers came out. Stock continues to go up. Skipper, KDDL, Shakti Pumps, Gensol Engineering. I can go down the list, but this is what went up with pretty significant volumes. Well, we watch US markets because that's the one which has been looking a little tricky. The economy there is doing very well. But that also means that the dollar is rising, which is the negative for not just emerging market stocks, but for currencies as well. Tomorrow, of course, is a holiday. We react to all that day after tomorrow.
Okay, all right, Prashant, thanks very much for that. Well, in market opinion then, Devina Mehra, First Global, believes that one should always invest because the risk of a crash in the market is low. Trideep Bhattacharya of Edelweiss AMC says the markets are 7% high from 70% away from the 2021 October levels. Listen in.
Even today, I would say the risk of a crash is far lower, and therefore you should remain invested, because the fact of the matter is that in markets, it is much more likely that if you sit it out, you will miss out on an up move. On a 40-year basis since the Sensex started, if you missed out on just the 10 best up move days, your returns go down by 2/3 if you miss out on 30 good days, which is less than the average of a day a year. Earnings or growth also, I reckon, would be not bad at all, given that for one, crude, while up from its lows, is still quite a bit down from its high. And crude is a big thing for India, both for the economy, because it drives a lot of things from bringing down inflation to current account deficit, driving growth.
October 21 highs, and from there where market is today, or it's about 7% higher from where it was the last high, and that was in 2021. And if I were to sort of look at the earnings and what they have done over the last 2 years, the earnings have been up by about 35% since then. So net balance, the valuations today are actually more reasonable than last time we hit all-time high and there or thereabouts. I would say the true nature of the earnings are yet to get reflected with regards to in the markets. So if you were to look at 12 months from now, where we would probably be clear of the macro event, which is the national elections middle of next year, and assuming all that fine, we should be kind of reasonably higher from where we are.
Okay, well, let's move on and take a quick look at the performance of the dollar index over the last 3 months. Surbhi has culled out some data. She's here to tell us more.
Well, I just started to, go back about 3-4 months to look at the genesis of the fall and to sort of map it to what's been happening in global markets. And the straight, clear link that came up for me was that this is global selling, as we've been saying, and it's linked to the strength in the dollar. Look at these charts. The top line is the Nifty, the orange line. The bottom line is the dollar index. Incidentally, these are in Independence Day colors as well. So here's what happened. The Nifty with the fall has come down to about this zone, and this is a zone which is where we were at the beginning of July. We're talking 4th or 5th of July. So the equity market has cooled off and come back to the 4th or 5th of July. These are levels where we are right now, 19,300 thereabouts. The dollar index was here. It fell all the way to below 100, and then again it has rallied back to levels of around 104. Again, if you just look at this part of the chart, then these two charts are mirror replicas of each other. Short point, the dollar has risen in the last month and a half, and consequently equities have fallen. It's a global trend. We've just picked up the Nifty because that's the market that is most important to us. So then I went back to just look at the distance from the top. When you see the fall today, it looks quite a lot, but the distance from the top right now is not that much on the Nifty at least. Nifty is down about 3.5% from the 52-week high. It's the banks which are the biggest problem for this market, and we've been saying that. So 5.5% down on the Nifty bank. Within this, PSU banks have not fallen as much. It's more large private sector banks which are leading this fall, and that's never a great sign for the market as a whole. The mid-cap index has fallen less than the Nifty. Till now, the mid-cap index is down just 2%. We need to see if this trend starts reversing and if mid-caps start catching up with the fall. And if the Nifty fall doesn't stop, then typically that's what happens. It's mid-caps and small-caps. The fall starts spreading to the broader markets. The small-cap index is also down only 2.5% right now. What else has fallen apart from banks? Real estate. That's where the blow has come in the month of August. Banks we've already discussed. Financial services index is also down. FMCG and metals, because of course it's a global fall. Interestingly, there's a return to safety. Your good old IT and pharma, they are what is working, and that tells you about the texture and the nature of the market that we're in. IT index, despite all the gloom and doom, is actually up 2.5% in August so far, and the Nifty Pharma obviously has been seeing some buying as well. Just some trends to put the fall in perspective.
Okay, all right, Surbhi, thanks very much for that. On to the second headline now. All 10 Adani Group stocks ended in the red today. This is after Deloitte has resigned as the statutory auditor of Adani Ports. The company has also appointed a new auditor, assuring it will resolve all matters in its September filing. Manglam Malu is here with more.
That's correct. So let's talk about what took place over the weekend. Deloitte had put out a note. In fact, they said that they've decided to resign as the auditor of Adani Ports. In fact, they said that they've resigned as they are not the statutory auditors of a substantial number of other Adani Group companies. In fact, the scope of audit does not extend to transactions incurred by or occurred between Adani Ports and other group companies itself. Remember, Deloitte had earlier qualified Adani Ports FY23 accounts on related party transactions itself. Adani Ports, however, on its part says that the board has accepted the resignation. That's not all. They've also appointed MSK and Associates CAs as their auditors, and this is among the top 6 names itself that we have. But importantly, to Deloitte's points, they've said that grounds advanced by Deloitte for resignation were not convincing or sufficient enough to warrant such a move, and it is not within the remit of the Adani Ports company or its board to actually recommend group-wide appointments. So those are two sides of the story. What is the street making of it? This morning we had a CLSA note which said that they've had many auditor changes in the recent past, and because one of the 6 global audit firms has replaced Deloitte, it is a limited fall that we're seeing. In fact, DHS's resignation may see a bit of a decline, but that decline would be a buying opportunity. They are buyers on the stock with a target price of close to 880 rupees per share.
Okay, all right, Manglam, thanks very much for that. So that's on the entire Adani story. But on to the third headline today. Divi's Labs gained nearly 1.5% in the last hour of trade. The company's commentary remained positive despite what was a weak quarter. So just to take you through the numbers in terms of Divi's Labs this quarter, they did report what was a margin improvement this time round. So revenue was down around 21% on a year-on-year basis. That missed estimates, but the margins came in at around 28.3% versus estimates of around 26%. And profit, however, was lower than estimates. Now, in terms of a couple of key points from the management, they did say they remain optimistic in terms of the opportunities emerging. Raw materials have, in fact, shown a downward trend, and they expect further softening going forward. They can retain margins on their custom synthesis segment, which is one of their key segments. Price pressure has seen some stabilization in the US markets. They are seeing improvement in terms of margin and growth. And overall, they seem to be more optimistic about projects coming in from big pharmaceutical companies as well. So that's the overall takeaways from Divi's Labs, where we did see the commentary really enthuse the stock despite that revenue disappointment. We'll take a short break now, but stay tuned. We'll be back in just a quick bit with all of the other top stories. Welcome back. Well, on to the fourth headline today. Nykaa recorded its biggest single-day drop that we've seen since November 2022, falling as much as 10% in trade. This is on the back of a decline in growth of its gross merchandise value and lower advertisement revenue for the June quarter as compared to last year. Manglam Malu joins us again, this time to talk about Nykaa. Manglam.
Nykaa was lower in today's trading session post their first quarter numbers, and here's 5 reasons why. Let's tell you the first one, that is weakness or moderation in their fashion business. The overall gross merchandise value grew by 24% year-on-year in the first quarter, but fashion business grew just about 12%. In fact, quarter-on-quarter, there was a decline of about 1.5%. That's not all. The company, their contribution margins in the fashion business also declined by about 50 basis points as they upped their marketing spends. The second reason, they do get advertising revenue from a whole host of D2C brands because of the platform nature of the business. That has moderated as well as the D2C players have pulled back on the ad spends, and the company itself is transitioning into a new ad platform itself. The third reason why the stock was lower was largely because the outlook is weak and the gross margins were down by 90 basis points because of the product mix, which was inferior on account of their eB2B, which is a superstore business for them. The fourth reason, there were brokerage downgrades on the back of that. So Nomura, for instance, downgraded its stock to neutral with a target price of 163. And the fifth reason, the stock, while it hasn't moved a lot from a point-to-point basis in the last 1 year, it's still trading at nearly 4.5 to 5 times 2-year forward price to sales, which analysts expect it to be rather fair value. So not a lot of upside from the current valuation levels as well.
All right, Manglab, thanks very much for that. Well, moving on to the financial space, NBFC space, Muthoot Finance slipped nearly 5%. This is after Morgan Stanley downgraded the stock, citing a rise in gold prices, which has driven loan growth. However, the company reported a good performance in its first quarter. Abhishek Kothari is here with the details.
The AUM growth has been pretty healthy at about 19.3% YOY and 7% sequentially. The gold AUM business growth has been pretty healthy as well, about 17.5% YOY and 6.7% quarter-on-quarter. Calculation shows that the ticket size might have increased by 12% YOY and about 5% sequentially. The net interest margin has dipped a bit to about 11.6% when compared to 12.3% in the previous quarter. The home finance subsidiary over there, the capital consumption was very high, so CRAR, that is capital adequacy ratio, has declined to 52% from 66% in the previous quarter. Belstar MFI, the performance remains strong. The AUM growth is about 49.2% YOY and about 13.2% sequentially. Now, we have a note coming in from one of the brokerages, that is Morgan Stanley. They have downgraded the stock to underweight from equal weight that they had earlier. They said that the gold price rise has driven Muthoot Finance loan growth this time around. Stock now appears to be consolidating. Structural risk to gold loan growth and yields from competition remain. So they have reduced their FY24 to 26 consolidated net interest margin by about 60 basis points to 11.7% from earlier 12.3%. And they have cut the standalone EPS of FY24, 25 and 26 anywhere between 3.5% to as high as 6.5%. But take a look. On the contrary, if you look at the results, data suggests that gold kept as security, which obviously happens when you take a gold loan, has increased by 2.25% YOY and about 1.1% quarter-on-quarter for Muthoot Finance. On the other hand, for Manappuram, it's declined by 11.5% YOY and about 1.3% quarter-on-quarter, suggesting that the gold price might have played a key role in Manappuram's gold loan growth this time around. So average ticket size, if you calculate for Muthoot, it's increased by 12.35% YOY and about 5% sequentially. On the other hand, for Manappuram, it's increased by 0.65% YOY, but the increase is tremendous on a sequential basis at 8.7%. Back to you.
Okay, all right, Abhishek. Thanks very much for that. Moving on, ABB India tumbled nearly 4% despite meeting street estimates on all parameters. Revenue and profit came in marginally higher, but margins were a big beat. Vivek is here with the details.
Well, at this point of time, it does appear to be a mix of both, given the fact that, going into this particular results, there was quite a bit of trepidation, given the fact that, once ABB Global had reported their numbers, there were worries, especially regarding the kind of ordering activity that the Indian arm was seeing. And but despite that, the numbers have come in very strong, including the order inflow too has been quite robust. Now, just comparing against our poll, while revenues were largely in line, a 22% growth on a year-on-year basis, margins have gone up quite significantly, coming in almost at 13.9% versus our estimate of 12%. So it's a strong beat versus the poll, given the fact that operational efficiencies, leverage, all of this have actually started kicking in. Now, let's look at the sore spot, given the fact what's actually happened. The base orders is up just 4%. This time around, ordering was actually aided by a one-off order from a metal company for over 159 crores. So this is something that actually aided the order book this time around. Going forward, it's going to be interesting to see whether the ordering activity continues to remain quite robust. But despite that, if you're looking at the order backlog, gives a significant revenue visibility. Order backlog at well over 7,700 crore at this point of time. But brokerages, especially Kotak Institutional Equity, have flagged off a few concerns. What they're saying, number one, they've downgraded the stock to a sell. What they're saying is that inline operating results actually suggest that moderating trends are witnessed as far as growth in ordering, revenues, as well as margin outlook is concerned. Along with that, it's an absolute sell as far as absolute valuations are concerned. And this, as you rightly mentioned, continues to remain an overhang on this particular stock.
Okay, all right, Vivek. Thanks very much for that. Well, let's move on. Nearly half of the IPOs launched since 2020 have delivered at least 50% returns. Thomas Fitakia is here with the IPO report card.
IPO season is well and truly back, and IPOs worth over 35,000 crores are lined up for the remainder of 2023. But today we'll take you back to the last 3 years, which has seen the launch of nearly 100 IPOs. A caveat we use here is that we've considered only those IPOs that have been sized at 500 crore rupees or more. So let's take a look at these issues. Out of the 94 such offerings over the last 3 years, 44 of them have returned at least 50% to shareholders. 20 of them have even doubled from their IPO price. This is as of closing last Friday. Among the most successful names include Happiest Minds Technologies, MTAR Tech, Mrs. Bector's Foods, and Craftsman Automation, which have tripled or even more from their issue price. Macrotech and Equitas Small Finance Bank completes the list, and I'd like to draw your attention to Happiest Minds Technologies in particular. It was one of the few IPOs that were launched during the COVID pandemic year of 2020, and amidst the uncertainty, it was still subscribed over 150 times. As of Friday, the stock had gained over 5 times its IPO price, but the gains could have been much higher had it not been for the stock nearly halving from its all-time high of 1,580 rupees. Yet, the stock is up a handsome 450%. Of course, if there are gainers, there'd be losers too. 26 out of the 94 IPOs are trading below their IPO price, and most of those names are new age companies like Paytm, Nykaa, PB Fintech, Aditya Birla AMC, but it is Craftsman Automation that is the worst performing IPO over the last 3 years, correcting nearly 70% from its issue price. I'm breaking the norm slightly for a special mention. Mazgaon Dock Shipbuilders was not a 500 crore IPO, but a 450 crore IPO. After a brief period of struggle, the stock has left the street spellbound over the last 2 years, and as of closing on Friday, the stock was up 13 times from its IPO price. So the key takeaways from this: 2 out of India's 3 largest IPOs, LIC and Paytm, are trading well below their IPO price, but 9 out of the 10 most successful ones are priced between 500 to 1,000 crores.
Okay, all right. Thanks very much for that. So interesting pipeline as well, worth over 20,000 crores for the remaining part of 2023 is what we can see from the IPO market. Thanks very much for that, Hormuz. Well, let's move on. The fifth headline today, the latest in the Adani-Hindenburg case. Market regulator SEBI has sought 15 more days from the Supreme Court to submit its report in the matter. SEBI has informed the top court that its investigation has progressed substantially. Out of the 24 matters SEBI was probing, it has concluded investigation in 17 cases and is awaiting information from foreign regulators as well as agencies. All right, well, some more earnings. ITC has reported its first quarter results. The FMCG major has met street estimates on profit on a standalone basis. Margins have also come in higher than expectations. However, ITC has reported a miss on revenue. Shilpa Ranipeta joins in with the highlights.
Well, you're absolutely right. It is a beat on the net profit. Let me run you through the numbers real quick. The net profit has come in about 4,902.7 crore rupees, and this is higher than a CNBC-TV18 poll of about 4,800 crore rupees. Revenue, however, has been a miss. Revenue came in about at 15.8 thousand crore rupees, which is against the poll of about 17,300 crore rupees that we were expecting. So that's a miss there on the revenue bit. EBITDA, however, almost in line. A very slight miss, came in about 6,250 crore rupees. Margins have come in higher than expected. They came in at about 39.5% versus a poll that we had about 36.8%. Now, the business segments, if I run you through that, the total FMCG business, the revenue for that includes FMCG others and the cigarettes business, also came in at about 7,400 crore rupees. That's about 13%, and we had an expectation of a growth of anywhere between 12 to 15% for the FMCG revenue. FMCG others, which is the pure play FMCG business, that grew about 16% with revenues of about 5,166. Hotels business grew about 8% at about 600 crores. Agri business, there has been a decline nearly of 24%, and the revenues there came in at about 5,705. Remember, given the macroeconomic situation that we've seen, unseasonal rains and all of that, agri business was expected to see a decline, and overall also the FMCG industry is still slowly clawing back with consumer demand coming back. Now, the other big headline here is the information that we have been given on the demerger. Now, according to the company, ITC shareholders will get 1 hotel share for every 10 shares that they hold in ITC, and the indicative timeline so far for listing of the ITC hotels business is about 15 months. Now, the company has also said that the hotels company will be given a license to use the ITC brand, and remember what was said earlier also, right? Post the implementation of the scheme, the shareholders of ITC will directly hold about 60% of ITC in ITC Hotels, which is the resulting company, proportionate to their shareholding of ITC, and the balance of about 40% indirectly. So in some way, they will have a stake in ITC Hotels, and this is part of, remember, the larger strategy of the hotels business, which is the asset right strategy to accelerate growth at a time where tourism is also coming back strong. And this will unlock value for ITC shareholders by giving them a direct stake in a pure play hotels entity also. Now, the necessary approvals from shareholders, stock exchanges, SEBI, NCLT, and other regulatory authorities is still required. And like I said, the indicative timeline for listing is about 15 months.
Okay, all right, Shilpa. Thanks very much for that. On that note, it's a wrap on this edition of Markets Today. Thanks very much for watching.